Thank you for joining the recorded version of Navigating Financial Decisions with Confidence. My name is Andrea Colleen, and I am the Outreach Coordinator at Consumer Credit Counseling Service, and I will be your presenter today. Consumer Credit Counseling Service of Rochester has been in the Rochester area since 1970. We are very proud to be a locally based nonprofit credit counseling agency. Our focus is on the financial health of individuals and families, helping those that we serve to achieve financial wellness through the programs and services that we offer. We're a member agency of the National Foundation for Credit Counseling. We're also licensed by the New York State Department of Financial Services. We are also a HUD approved housing counseling agency and a member of the Better Business Bureau with an A+ rating. This presentation is designed to equip participants with the knowledge and confidence to make smart borrowing decisions for home, auto, and student loans with informed financial strategies. In our session today, we will discuss financial readiness, how loans work, credit report and score, making informed decisions, and resources offered by CCCS of Rochester. When trying to assess financial readiness, one of the first steps that you can take prior to navigating loans is to really understand your financial mindset. So identifying your personal money habits and beliefs will help you create a strategic approach to managing finances and more. So looking at early money influences, how your family handled money or how money was managed as you were younger and what beliefs were created at that point. Reflect on different emotions tied to money. Maybe there's times in our life where we tend to spend more or make more of an impulse purchase if we're stressed, if we are overwhelmed, if we are happy or have some excitement, or even facing fears. Consider your financial values. What matters most? Security, freedom, generosity, those are just a few examples. But when we link the goals that we have and the way that we manage money to things that are fundamentally important to us, and we're mindful of this, we can tend to spend money in a different way, or maybe maintain and meet some of the financial goals that we're creating. It can develop a confident money management approach. It is a step-by-step process, and we want to give ourselves some grace when it comes to making changes or making ourselves more aware. But these are a few tips that you can utilize to understand your financial mindset, which is one of the very first processes that we can manage to be able to take our next steps when it comes to navigating loans. Whether we realize it or not, we make many financial decisions on a daily basis, whether it's small purchases, things like managing or balancing our bank accounts, and saving for specific goals. We also need to make decisions about borrowing, whether it's a car loan, mortgage, student loans, and more. Some of the components that we need to start to assess our financial readiness are looking at the current financial goals that we have, breaking them down to monthly savings. Also, looking at our monthly income and our expenses. We can categorize our expenses into three categories: fixed, flexible, and periodic. Fixed expenses stay the same each month. Flexible expenses are paid every month or several times throughout the month, but the amounts can change. And periodic expenses can be expected or unexpected, car repairs, medical expenses, etc. So just putting your list of expenses together and comparing it to your income along with your other goals is a great start trying to determine your readiness when it comes to finances. If you're looking for more of a deep dive in structuring your spending plan and establishing savings and goals, please attend our workshops that we offer the second Tuesday of every month regarding budgeting and just managing your debt in general. Analyzing your spending pattern is a really helpful way to see where your money is going, and it also teaches us to be more mindful about not only what we're spending, but how much things cost. So track our daily expenses for a month and just see where our money goes And this can also help us to identify impulse purchases or different triggers that can cause spending. It can be linked to our emotions like stress, boredom, social pressure. Another strategy is just taking a look at bank statements, credit card statements, receipts, even if we have a membership of to an organization or a place or a store that we're shopping at, maybe we can get an online view of like what purchases we've made. This can be eye-opening just to really see where our money's going, and it can help us when we're trying to navigate decisions, whether it's getting a loan, what type of loan, what can I afford, is to look at where our money's going and how we're using it so that we can put it to the best use. The next part of assessing our financial readiness is to take a look at our debt situation. You can pull your credit report at annualcreditreport.com for no cost, and you can do that actually once a week. You can also gather any statements or any lists of the current debts that we have. The three credit reporting agencies are Experian, TransUnion, and Equifax. To get familiar with a credit score, there's different resources, one being myfico.com. Another is Credit Karma. Credit Karma is a website that a lot of people will utilize just to kind of get an average of what their score is. This will supply a Vantage score, not a FICO score, so there is a difference. It's not the same scores that our lenders are looking at. So we'll talk about that in a few slides, but it's still a great way to get started. You can also go to your bank's online service and take a look at whatever tools that they offer. Many banks and credit unions do have a way of viewing your credit report and your credit score for no cost. When qualifying traditionally for a loan, there are a few things we need to consider. The first thing we want to do is provide proof of who we are, our identity, our residence, proof of our income through pay stubs or tax information, a credit score, which we will talk about, a credit score to see how well we manage the current credit and debt that we have, as well as capital or down payment, whether it's money for a down payment or money that we need to have set aside as a reserve. When it comes to getting approved for a loan, there are four different factors to be considered regarding that decision. The first C of the four C's of credit is your capacity. Capacity means how much money you have available to pay for the loan. So if you're getting approved or trying to get a car loan, a mortgage, a home equity loan, they meaning the lender, will take a look at our income and what other debts we're paying on top of that to determine if it's affordable or not. So the affordability is called capacity. Character is a word that's used to describe how well we manage our current credit or debt situation. So here is where our credit score comes into play. And we want to make sure that the debts that we do have are paid on time, that our balances aren't too high, and that we don't have too much overactivity in the form of inquiries on our credit report. And we'll talk about that in a few slides. Collateral is the value of what you are purchasing. So the collateral, for instance, for a vehicle loan would be the vehicle. For a mortgage, it would be the house that you're purchasing. Sometimes someone can have a really great character, credit score, and income and still be denied for the loan if what you're trying to purchase isn't coming in at the appropriate value. It could be a risk to the lender. Capital is the amount of funds or savings you have. Maybe we need this for a down payment, or in some circumstances, we want to have set asides or reserves for certain types of loans. We'll discuss this later in a few slides. Having all of these four components in a balance when it comes to credit is what can help you get approved for loans and make healthy credit decisions based on these factors. It's not all about credit score. It's about having a balance with affordability, savings, credit, as well as value in the item that you're getting a loan for. A credit score is basically a grade for your credit report, and a credit scoring model is just a more simplified plan or more simplified process for lenders to determine their risk level based on how well we pay the current debt we have, among other factors. There's different types of credit scores. The most popular one that's used by lenders is called a FICO score. A FICO score typically ranges between 300 to 850. Another example would be Vantage. Vantage can range between 500 to 990, though there are some models that are a bit closer to the FICO score. In my experience, or in our experience here, most Vantage scores are the type of score that you can get for no cost. They may offer some free services, and looking at a Vantage score is not a bad thing. It's just not the same as what the lenders might be viewing. Different lenders have different score requirements depending on what it is you're trying to purchase and the different elements of what your credit score is reading. Your credit score is one of the four components that's considered as if you're going to get approved for a loan or not approved for a loan. So we had capacity, collateral, character, as well as capital. But to have a good credit score, what we need to do is pay any debt or any debt or any bills that we currently have on time. Keep our credit balances low. We don't want to exceed the limit on anything or get too close to our limits. We want to have a good history of using credit, at least a good year or two. The longer a history and the more we sustain our monthly payments and stay in line with the other things like paying on time and making sure we don't get close to the balances, your credit score will naturally increase. So that history is a part of it. Different types of credit. We'll learn in our next section the different types of loans, but the two that we'll talk about are installments and revolving. Installment are things that have a starting and an end date, so they're loans that have like a monthly payment that would be paid off in a specified period of time at a simple interest rate, which we will discuss. And revolving is more like the credit cards. So when we have an open line of credit, the interest rate can fluctuate and we're making payments based on the type of debt. We don't want more debt, but if we have different categories of debt, say a car loan, while we're maintaining a credit card, the credit score may tend to increase as long as those are being managed well. The last section of our credit report, or the last piece of information that's reviewed and utilized, is the inquiries on our credit report. An inquiry is anytime someone views your credit report, including yourself. Us looking at our own credit report will not impact your credit. It will show up so that you can see who's reviewing your credit. That's a good thing, but it will not hurt you. The things that can make our score go down is when we're applying for too many credit cards or too many loans, specifically in a shorter period of time. So we really want to be careful with who we're giving access to view our credit report with. A loan is when you borrow money from a lending institution and agree to pay it back with interest. And interest is a fee that you pay for borrowing money, but it's charged in a percentage. Different loans have different rules, benefits, and risks. There are two types of loans, secured and unsecured. A secure loans have collateral, meaning that they're most likely used for an item that have more value, like a vehicle or a home, meaning that if you don't make the payments, the item could be taken away or a home could be foreclosed on. Unsecured loans do not have collateral. More examples of these would be a credit card, a charge card, some types of personal loans. They usually have a higher interest rate because they're more of a risk for the bank to offer these. And the interest can truly add up over time. So unsecured loans are basically debts that we have that there is no collateral against. Now we'll talk about fixed and variable interest rates. If an interest rate is fixed, that means it will not change throughout the life of the loan. Most installment loans are fixed. So that's something you really want to make sure that you're aware of. And even if someone was to be late on a payment or miss a payment, your interest rate will not increase. Variable rates are not fixed. Variable rates can fluctuate depending on the market or depending on our payment history. Most credit cards have variable interest rates. So it's something we want to be aware of. Like, it's very rare to get a fixed rate credit card. So just to kind of think through that. And if we're late or we miss a payment, the interest rate could increase substantially. Interest can also be charged differently. Simple interest is interest that's charged on an installment loan, and it's a fixed rate. So the interest is charged on the initial amount that you borrow over time. Compounding interest is an interest that's calculated on both the initial principal and the accumulated interest from previous periods. This means you're paying interest on previous interest that was charged. Interest rates may fluctuate, and in some cases, or in most cases, are variable, and they're usually charged on credit cards. Mostly, compounding interest will cost more than simple interest over time because of the way it's calculated. Installment loans are loans where payments are made over a specified period of time, usually over a matter of years. The interest rate is fixed and it cannot change, and the interest is charged as simple interest. That means that the interest is charged on the initial amount that you borrow. Payments are based on how much money you borrow, your rate of interest, and the term, meaning the time frame. So an example could be 5 years for a vehicle, 10 years for a student loan, or up to 30 years for a home mortgage. So those are the type of loans that are considered installment loans. In many circumstances, a longer original term of a loan can increase the interest rate that's being charged. For example, if you were paying a car loan at 3 years, 36 payments, your rate would be lower than if you opted for the 60-month payment plan. So the longer that we take to pay on something, the more interest that we pay over time. And again, the loan term is the specified amount that we pay for something. For installment loans, or really any debt for that matter, paying more than your minimum payment will save money in interest and pay the loan off faster. But something to be aware of is some loans may charge a penalty fee if it's paid off too early. For instance, if a mortgage is paid off, prior to a specified amount of time, there may be a percentage of a fee that's charged. So the way that we can do that is to look at your original paperwork or reach out to the lender to see if there's any additional fees that are charged. Revolving credit is another type of credit or another type of loan for that matter. Payments are based on the balance. The balance may fluctuate depending on how often we use it. This type of debt is mainly called, or credit is mainly in the form of credit cards or charge cards. Now, one thing to be aware of is that credit cards charge compounding interest. This interest is charged on the balance and any current interest that has been applied to the balance. Interest rates are much higher on revolving credit, and they can be very expensive. If you add up over time the interest that you've paid on a credit card, it could take years, additional years, to pay off. In some matters, the interest that you pay may be more than what you initially spent. So there is a difference between the way that interest is charged on a credit card in the form of compounding interest versus the way interest is charged on an installment loan known as simple interest. Personal loans can be used for really anything that you're looking to obtain. Personal loans are not secured. So that means, most people won't just take a personal loan out to pay for a car or a house or something like that. They can charge a higher interest rate than, say, a mortgage loan or a car loan. And you want to be cautious of how much you borrow and be sure to have a plan to repay these loans. Personal loans typically they're not too high of a balance. Your income will come into consideration as well as your credit score, but usually they won't give large amounts out without some type of collateral against it. A car loan is when you use money borrowed from a lender to purchase a car, and the car is collateral, meaning if we don't pay that loan, they can repossess or take the vehicle away. Once you pay off the loan, you'll own the car outright. If you don't make the payments, the lender can take the car and they can sell it. You'll still have a balance left on your loan. Typically, whatever they would get for at the auction that they would sell it at, they can apply toward your loan so that you would owe a lot less, but that's quite the process to have to go through and it can significantly damage a credit report. If the lender doesn't sell the car for enough to pay off, you pay off the difference. That's called a deficiency balance. A car loan is basically a loan that we're obtaining for an automobile. Car loans are typically financed between 3 to 6 years, with the most popular option being 5 years or 60 months. When it comes to car loans, the longer your payment term, the higher the interest rate. The longer your payment term, your total payout will be more because you are paying for a longer period of time. So in the chart, you can see for a $20,000 vehicle, if we were to put $5,000 down and finance $15,000, the interest rate at 7.99%, which is about average right now for 4 years, a payment would be $366.12. $366.12 over 48 months is just about $17,000. So there would be an additional $2,000 paid out. If we weren't to put any money down on a car loan and finance the full 20 at a higher rate of 9.85 for a higher period of time, your payment would be $423. $423 over a 60-month period is closer to $25,000, so it's $5,000 more than the initial purchase of the vehicle. So it's important to kind of get a feel for where interest rates are. Interest rates have increased over the past few years. These examples here are average rates. The newer the vehicle, the lower the interest rate. The older the vehicle, the higher the interest rate. So those are things that could be considered. It's great to find some kind of an auto loan calculator, whether it's at your own bank or credit union, to kind of get a feel for what monthly payments would be based on the balance, the interest rate, and the length of time you're planning on paying. When someone is upside down on a car loan, what that means is they owe more on the car loan balance than the value of the vehicle. You can see in this example here where they purchased a vehicle for $15,000. They financed it at a higher interest rate for 72 months, so that brought their balance to $25,000. So after a 2-year period, they have reduced their balance to $17,000, but the car value has also decreased. This can be a sticky situation for someone when they're managing car payments, especially if they're looking to purchase a new car and they owe more than the value of the current loan. Our agency does offer counseling to help individuals looking for a vehicle loan have access to affordable car loans. You must live in Monroe County, and there are some income limitations. To get more information on this program, you can use the link supplied below or the QR code on this page. The program is called the Driven to Success program. Student loans are designed to pay for educational costs, mainly college expense. They can be federal or private, and you usually start paying these after you have finished school. These loans are traditionally paid for 10 years and can range anywhere between 6 to 9% interest. It could be a little higher, it could be a little lower. This was as of 2025. Federal loans mean the money is borrowed from the government to go to college. Loans can be subsidized interest. This means that the interest does not apply while you are in school. It can also be unsubsidized interest, meaning that the interest does apply while you're in school. That can definitely be an important concept when determining what your loan balance and payments will be upon graduation. Federal student loans are not usually credit-based unless you're applying for a loan for graduate school or a Parent Plus loan. There are several repayment options. Typically, once an individual is no longer full-time or graduates, within 6 months payments will begin. A standard repayment option for a student loan is usually a 10-year payment based upon the balance and the interest rate, so where your payment would stay the same until it's paid off. There are also some income contingent plans available. There are several plans, and this is where payments are based more upon your income. For more information on those type of programs, there are 2 agencies that you can get your information from that we would recommend. The one being EdCap, where you can see the link available there. That's a program for New York State residents. And also the FSAID, the Federal Student Aid website, can give you lots of information about the different programs and information about some types of loan forgiveness. If you're employed by a government or not-for-profit organization, you might be eligible for the Public Service Loan Forgiveness Program. This program can help forgive a remaining balance on a federal student loan. There are some eligibility criteria, and the one thing that I want to make clear is that a lot of times people think because they maybe work for an appropriate or eligible with an eligible employer that they're automatically enrolled into that program, and you are not. You must complete an application and to ensure that you are within that program, and that's when the 10 years starts. So for more information for student loan forgiveness for your particular situation, you can visit the studentaid.gov website and enroll and get all of the information that you need to make sure you're on the right track. Private student loans are money borrowed from lending institutions. We want to make sure we're using the federal options first, as they're typically a lower rate and offer many more repayment options to benefit us in the future. Interest rates may be higher or fluctuate, and payment options are limited. Private student loans may be based upon credit and affordability, and in some circumstances may be needed to start paying while someone's in school. Mortgage loans are loans that are used to purchase a home. These are usually secured installment loans. Your interest accumulates on the amount you have borrowed. They usually range anywhere between 10 to 30 years in repayment, and in most cases will charge a simple interest. In some cases, there are adjustable rate mortgages where the interest rate can change annually or it can change every few years, whatever the initial contract says. That can cause your payments to increase. So be sure to know the difference. If you do not pay your mortgage, your house can be foreclosed on or taken away. Mortgage loans do tend to have a lower interest rate than, say, a personal loan or a car loan or definitely a credit card. There are also other expenses that go along with it, as well as your property taxes, homeowners insurance, and typically home loans can average between 6 to 7% or higher depending on your credit situation as of 2025. Let's take a look at a mortgage interest example. So if someone was to purchase a home for $150,000 at 6% interest over a 30-year term, here's a breakdown of how much you would pay. Your monthly payments would be just about $900 a month. That is not including taxes or insurance. And your total payments over 30 years would be $323,757. Okay, the house is $150,000. So how much of that is interest? About $173,757 of that would be the interest cost. And it's not that that's good or bad or wrong or right. That is what interest costs. So when we see things like this, it helps us to make informed decisions as far as like what's affordable. And it also helps us to understand how quickly interest can accumulate. And it might motivate us to look at our goals, look at our expenses, and try to pay additional funds or try to pay it off faster or try to get a lower interest rate. So understanding the total interest paid over a life of a loan can help you to make these decisions. Many banks and credit unions participate in different grant programs or offer their programs. So a grant just basically means free money to help you with down payment costs or upfront costs when it comes to purchasing a home. So they do help you with that. You want to check the websites of like local lending institutions or your current institution. And one of a really helpful thing that you can do is to take a course to kind of educate yourself about buying a home. And a lot of the grant programs actually require a HUD certified course. So our agency does have a HUD certified course that can be taken online. There is a $75 fee for this course, and it could be accessed either using this QR code or you can click the link depending on how you're viewing this. Some key takeaways that we want people to really get out of this workshop was to understanding your loan options. There's so many different types of loans and interest rates and things we can get loans for, but just to kind of know the major things, mortgage, auto, student, personal loan, and just kind of how credit works, understanding the fixed rate versus a variable rate, unsecured versus secured loans, and how interest is charged as well. Borrow smart. Only borrow what you can afford and repay comfortably. Keep an eye on your credit score as well as your debt to make sure that we're definitely progressing and that we have a good hold and understanding of where we stand when it comes to our finances as a whole. A few other takeaways to review are know the cost, not only how much interest you're paying, but how much that adds up over time to really develop our plan and really get that feel for it, or any other fees that can be charged. Use loan calculators and estimate your total repayment. Look at the amortization schedules, which is like a total payout of how much things would cost over time. And then planning for repayment. Set up our budget that will work for you to really reach the goals that you're trying to reach. But we can reach goals easier if we're not paying out so much debt. So, make those considerations. So paying more than the minimum. I know we've heard that, but sometimes we really want to see those numbers in front of us to figure out like how much of a difference will it make over time. Compare different lenders and terms and offers before committing. Ask about things like a prepayment penalty or a fee or discount, just so that you have a full understanding. And when you're going into these decisions, you're making them in an informed manner. Now we'll talk a bit about how the nonprofit counseling agencies can help you achieve goals through financial management. Our agency, Consumer Credit Counseling Service of Rochester, is here to offer support and guidance if there are people that are struggling with managing expenses and managing debts. We are open Monday through Thursday from 8 until 8 and Fridays from 8 until 5. A scheduling session is typically booked for 1 hour. It can be done in person or over the phone. During those sessions, we can look at your goals, we can help you look at your budget, take a look at the debt, and develop an action plan to help you get on the right track to managing your expenses and paying things off. We do have programs to help people consolidate their debt as well as reducing interest rates and helping people get current, among other programs to really help them manage their financial goals. At the very least, you would feel organized and in control. If you would like to set up an appointment, you can contact us via phone, or depending on how you're viewing this presentation, you can utilize the active link that is upon the slide, or you can take a photo of the QR code. This will bring you directly to the appointment page. Thank you for taking the time to listen in on this workshop today. We do hope it was helpful and got our minds going about different strategies of savings when it comes to goals and really helping us reach a level of financial peace of mind. Again, here's our contact information. Depending upon how you're viewing, there is an active link to complete an evaluation. You can utilize the link via SurveyMonkey, or you can scan the QR code and it will bring you directly to the page. There's just a few final questions to complete that evaluation. So thank you very much for taking the time to listen in today.